If you're thinking about opening a bank account for your foundation, two jurisdictions are prominent in this space, that is Switzerland and Dubai. Both are well known, but they offer very different experience. So in this video, we will explain how each country handles banking for foundations, including how hard it is to open a bank account, what the cost looks like, and how flexible the rules are, as well as whether banks will even accept your structure or not. This comparison could save you time, money, and unnecessary delays. Before we start, my name is Shiraz Baid and I'm the founder at Lepidus Wealth, where we help clients and families protect their assets using a range of tools including trust, foundations, wills, and offshore structures. So if you own a business or real estate, don't wait until a legal or health crisis to start thinking about protecting what you have built. Instead, request your free and customized asset protection plan by clicking the link below. You can then implement it step by step as your journey progresses. Both Switzerland and Dubai allows private foundations to hold bank accounts in their own name. That's a critical point, especially for those managing family wealth, succession, and international assets. But how easy it is to actually open that bank account. In Dubai, foundations typically fall under the DIFC or ADGM regime. These are internationally recognized common law jurisdictions with a clear regulatory framework. Banks in Dubai understand the foundation structure well. In many cases, you can open your bank account within 4 to 6 weeks, especially if your documents are in order and the foundation has a clean structure. Local private banks and international banks with local branches are familiar with the KYC expectations for foundations, which helps accelerate the process. In many situations, we see the accounts get activated in under a month when the client is properly guided. Some institutions even have fast track onboarding desks specifically for DIFC or ADGM structures, reflecting Dubai's proactive stance on international family wealth. By contrast, Swiss banks are known for their discretion and conservative onboarding process. While this works well for established clients with a strong track record, it can be a hurdle for newly formed entities or those with complex ownership. Foundations without an existing Swiss banking relationship may face extra scrutiny. This often translates into longer lead time, more documentation, and additional justification for the source of funds and beneficiaries. It's not unusual for onboarding to stretch into multiple months without the right local introduction or documentation flow. In some cases, bank may ask to see notarized translations, enhanced due diligence files, or even live portfolio transfer plans before proceeding. Now let's talk about perception. Dubai's rise as a wealth management hub means that foundations here are no longer seen as opaque or something exotic. On the contrary, the structure based in DIFC or ADGM are generally viewed as clean, regulated, and bankable, especially if founder is resident or has regional ties. This makes a real difference during compliance reviews. With the right advisors and proper presentation, it's possible to open accounts not only in Dubai, but also in Singapore, Luxembourg, and even Switzerland itself using a Dubai foundation. We are seeing more international banks treating Dubai Foundation as mainstream rather than alternative. Even some traditional institutions that were once cautious about newer jurisdictions are opening up DIFC and ADGM entities that come through a qualified introducer. In Switzerland, however, the perception cuts both ways. The jurisdiction is still respected globally, but the banking system is under more pressure from regulators to verify cross-border structures. Foundations that lacks the clear justification of being based in Switzerland, such as Swiss founders, asset base in Europe, or operational presence, may be deprioritized. That doesn't mean it's impossible, but it does mean your onboarding will be slower, more expensive, and more document heavy. For certain profiles, especially first time founders or smaller balance structures, this can become a roadblock. And with increasing intergovernmental reporting obligations, the cost of staying compliant can outweigh the perceived advantage of Swiss neutrality for some families. Fee is another consideration. In Dubai, private and corporate accounts for foundations are often structured with monthly relationship fee or minimum balance requirements, but tend to be lower than Swiss private banking thresholds. In Switzerland, you can expect a high starting point of 1 to 3 million Swiss francs. If your foundation is intended to hold family assets passively or to serve as part of the holding structure, Dubai may offer more cost efficiency without sacrificing the credibility. It's also easier to test and scale before committing to a heavier structure. Several Dubai banks often offer modular account services, allowing founder to expand the banking scope only as the foundation activities grow. One often overlooked factor is control. Dubai foundations allow a high degree of flexibility when it comes to appointing the council, assigning protectors, and structuring distributions. This makes it easier to align the foundation with your broader planning objectives. Whether you're building a family office, structuring cross border holdings, or setting up charitable disbursements, Swiss foundations, while reputable, come with tighter governance rules, especially for charitable or hybrid forms. For private wealth structures, this rigidity can sometimes get in the way of administration. Founders looking for long term optionality often lean towards Dubai for this reason. The ability to change foundation bylaws without court intervention, for example, is a small but impactful advantage. Another point worth noting is the digital banking access. Many Dubai banks now offer fully digital onboarding for UAE residents and corporate account holders, and some are extending this to the foundations. This is especially helpful for international founders who travel frequently or prefer remote management. Swiss banks are also catching up but remain slower on the digital front, with most requiring at least one in person meeting. This single logistical issue can delay things by weeks. In the post COVID world, seamless digital engagement is becoming a minimum expectation, and Dubai is clearly ahead on this front. So, which jurisdiction makes more sense? It depends on your priorities. If you value legacy, reputation, and willing to invest in relationship, Switzerland remains a strong contender. But if you want speed, flexibility, lower entry threshold, and access to broader global banking network, Dubai may give you a smoother, more practical path. More and more international families and business owners are discovering that Dubai offers 70% of what Swiss banking once promised, with far fewer barriers to entry. And for those managing fast moving portfolios, family transition, or first generation wealth, that agility can make all the difference. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.